Okay, traders, we're back. Okay, a couple of questions here from Ken. As far as how we're going, we're probably going to go to about 1:30ish, 2 o'clock or so. All right, listen. Okay. Ken, you're also asking, what tells me that we're entering in a period ideal for swing trading? Well, that's a good question. If we go back to the whole cycle concept, okay, your best, your greater periods of volatility tend to exist here, okay, in the cycle, in the macro cycle. So I believe that we are here in that cycle, okay? And you have a higher degree of salt and pepper. You have a higher degree of like these, a higher amount of consistency where stocks take this really sharp crack and then they rush back with a vengeance, only to take another big giant crack. The back and forth, the salt and pepper, the powerful moves on both sides, not just one side, all right, picks up in the late stage of one mode into the transitional pocket right before another mode. And that's where I believe we are right now. And you're seeing exactly this right now. You're seeing, whoa, boom, market took a big one-day hit. But whoa, my goodness, look at how it rushes back. You know, it's not normal. You see, in a solid 2, you get the big rushes on the vast majority of time on one side of the equation. On the upside, the pullbacks are milder, they're more under control. They're not collapses. They're not frequently collapses. And not that you don't have collapses. It's just that they're few and far between. It's not that every drop is like, whoa. You know, they trickle downward. They grind downward. They drift downward and then boom, up to the upside powerfully. That's your typical 2. But when you've got the power on both sides and it's consistent, you're in a transitional pocket. And that makes for swing trading should be the predominant style when you're in those pockets. You know, it's not the trending. Because if you think trending in the transitional pocket, you're gonna get hurt. All right. So that's where I think we are. All right. Let's talk about locations. Now, before we go into the locations, I have to obviously tell you that we use in swing trading, we use 2 predominant moving averages. And they're both simple moving averages. We use the 20 period, of course. And we use the 200. There are others. There are others like there's the 100 and the 50. There's the 8 period moving average on the shorter side. But these are the 2 dominant moving averages. Now, We're not going to cover the 200 at this particular point. That moving average is just predominantly used for major support and resistance, and it is the sixth location in truth. There are 5 dominant locations. The 200 is the sixth location. But the 200 is more of a location than it is really a moving average as far as I'm concerned. It's the 20-period moving average that you need to have on every single stock you look at. As far as I'm concerned, you're not looking at a stock or a chart without this on it. This is the vertebrae of your play, and we are going to look at many different charts today. All right, we're going to look at many different real examples today. We're covering theory now, but we will definitely go to real examples. Okay. So it's the 20-period moving average, and it is from this single moving average that we derive all of our locations from, with the exception of the 200, the sixth location. But the 5 dominant locations are derived from the 20-period moving average, right? So the way that goes is this. You have location 1 is when your play or when your stop is at the 20-period moving average. It's 20-period moving average. Now, this is 20-period moving averages of the daily chart. When we swing trade, we are trading off of the daily chart 99% of the time. So when I say the 20-period moving average, is the 20-period simple moving average of the daily chart. It's averaging the closing prices over the past 20 days, and that line represents the average price, the average close, or the average price. So it's literally just adding the last 20 closing prices, dividing by 20 to give you what the average price was over the past month. It's really a monthly moving average. Average 20 trading days in a month, and that's what you're looking at. Now, when your stock or your play is occurring at the 20, what do I mean by at? On it, touching it, intersecting, all right? Your stock is actually touching the 20. Or your play, or what I'm going to teach you is your play or your event is touching it, crossing it. Okay? That's what I mean by at the 20. That's location 1. When what I'm going to teach you occurs at the 20, it is a light buy. Okay? So we're going to break all of our swing trades into light, medium, and heavy. These are the light buys. If it is your stock and or your event that I teach you is a little bit above the 20, it is a light buy as well. Okay? Now, maybe light is not the quite the right word. What I would actually prefer is normal. These are your normal buys. When you begin to step up from normal, you go to medium and heavy. So don't think of light as less than. Light is normal. So every trader, every swing trader must have, this is what I do normally. On a normal play with normal odds, I play this. That could be share size or it could be a dollar amount. Under normal circumstances, I risk $5,000. I put $5,000 into normal plays or whatever. I'm just coming up with an example. Or on normal plays, I play 500 shares or I play 300 shares or whatever it is. So it can be a share size, it can be an amount, but you need to come up with a constant normal that you play for normal odds plays. Now, from there you go up. So normal could be 300 shares, medium could be 500 shares, heavy is 1,000 shares. It could be something like that. 3, 5, 1,000. Or it could be I put 5,000 into a play. Normally, I put $10,000 into a play if it's medium and 15,000 if it's heavy. You know, what have you. But you need three layers of buy, because in our swing trading program, you're going to hear me say this is a medium buy. So what is a medium buy dollar wise might be different between us, but as long as we are playing the same size relative to our portfolios, we're still playing the same. So if I do medium and you do medium, we're the same, no matter irrespective of the specific dollar amounts. There are times I'm going to tweet or I'm going to alert you on a swing trade and say, we're going to do light here, or we're going to do normal. And there are times it's going to be, this is heavy. The risk is small, the reward is great, this is heavy. And you must have that predefined. So you must divide your plays into 3 levels. Okay? Now, so if your stock, generally speaking, these are all general guidelines. There are exceptions. But if your stock in the play that I teach you is occurring at or touching the 20, it's light. If it's occurring just above, I mean, almost touching, but not quite touching, a little bit above the 20-period moving average, it's generally speaking going to be a light play. If you start to see your stock below the 20-period moving average, not touching, but just below, it's light to medium. Sometimes it's medium, sometimes it's light, or sometimes it's normal, and sometimes it's medium. All right? But if we get deep below the 20, then chances are it's medium to heavy. Now, notice the direction. So think of a stock coming down toward its 20. As it approaches its 20, you start to get interested. Normal buy right above it. Touching it, normal buy right above it. Below it, normal to medium. More below it, medium. More below it, heavy to medium. More below it, heavy. That's the order. The deeper, the heavier the possibility of your play, which makes sense because remember the cycle that I told you about and how the cycle is broken up into 4 parts. If you're declining towards your 20, you are in a micro 4. If you cross the 20, you are, let's say you are potentially, let's say the 20 represents the midpoint of a decline. Sometimes declines only reach their midpoint and then rally back to the upside. Sometimes they go a little bit past their midpoint and then rally back to the upside. But sometimes that midpoint is the midpoint. And so it is going to cross the 20 and go deep below the 20 before it bottoms out and returns. Those tend to be the biggest and most violent snapbacks, which is why we actually increase our size a bit. The deeper below, generally speaking, not always, but generally speaking, the deeper below the midpoint, the deeper below the 20-period moving average, the heavier the buy, which makes sense because the deeper you are in 4, the closer you are to the bottom and a relatively violent snapback to the upside. Now, again, this is all thinking and assuming that this micro move down is in the context. It is a micro move down in the context of a much larger move up. All right. That would be with a rising 20-period moving average. Sometimes a flat 20-period moving average. But generally speaking, yes, Pedro, a rising 20-period moving average. Better. Now, so at the 20, light, normal, a little bit above the 20. So really, if you think of a stock coming down, I should do this red, right? If you think of a stock coming down, and then here's the 20, this is now a little bit above. This is at, this is a little below, and this is far below. All right? This event here is occurring in location 4 and makes for a heavy buy. This event is occurring in location 1, which makes for a normal buy. This event is occurring just below normal to medium or light to medium. So as you can see, the deeper you get below, the greater the odds of a slightly heavier play, which makes sense because the odds that you are finished with 4 are higher here than here. You see? So the odds of being wrong are a little bit higher here. And the odds of being right are a little bit higher here. It's counter to what a lot of people feel. Whoa, we've broken the 20-period moving average. They think we've broken support. That means that it's worse, no? Not necessarily. Not necessarily. You can lean on, you can think of it as a boomerang in a way. And the 20 is the rubber band, right? Now the 20 can get pulled back some and then shoot the arrow upward, right? Then you can pull the rubber band back a little bit more and shoot the arrow or the stone or whatever you're flinging with your little slingshot. When you can pull that slingshot way back, and it will catapult with more velocity. There is a point where you can pull it back and just break the rubber band, and we know that. But assuming that's not the case, sometimes the deeper you pull that rubber band back, the further you're going to fling your stone. So if you think of the 20 not as a static point that can be broken or shattered at a little crack through, it's not a sheet of ice, it's a rubber band. Do you follow what I'm saying? Does that make sense? All right. So, Terry, I think what you're asking is, okay, Oliver, this is all well and good, these location points in the context of an uptrend where, okay, I'm now dipping below, sometimes not below, but what about a transitional phase where it's really problematic, right? And sometimes, this is largely what stops are for, because sometimes you are potentially buying into one of the declines that's not temporary, and that is your breakdown. And we all need a catch-all for those. Because if that were not the possibility, then why would there be a need for protective stops at all? Right? So occasionally that's going to happen, that one of these declines may have the appearance and almost all of the characteristics of being a temporary dip that should fling back to the upside, but it's not. And that's part of the numbers game. Now, you know what a lot of novices get hung up on? They actually get hung up on having to, they believe that every losing trade is a reason to go to the drawing board and tweak something. And what a colossal error that is. That the futile attempt to erase or eliminate in your approach losing trades is the hallmark of the biggest novice of all. Losing trades are your friend. They're a necessary tool. You should welcome them, actually. I mean, to suffer a small loss and now know that, okay, pullbacks now are not temporary. We're transitioning. My God, that's a small price to pay for that incredible amount of valuable knowledge. All right. They are feelers. They communicate to you when you approach them in the right way. They're not to be eliminated. They can't be eliminated. But we can certainly mitigate them. We can minimize them by obviously playing and doing the right thing. But you can't assume that because you gotten stopped out, something was wrong. All right. Whoa, why is my arm in pain when I put my arm on this flame? Something must be wrong. No, that pain is necessary. It's the way the body communicates, the brain communicates to your body that it needs to move. You know, it's losing trades, the pain. It's the way your knowledge lets you know that, wait a minute, okay, something is transitioning here. It's not temporary. You need to move. And now it becomes your friend. It becomes your aid. It becomes a tool that you lose. The master trader's losses are his tools. That's a specific tool in his toolbox. They're messengers. They're not the messenger that you're doing something wrong. They're the messengers that, okay, things are changing because what normally works is not working now. All right. There are these neutral zones that blend light, medium, or heavy. So for instance, you can be below a little, there's a little bit below and then there's far below, right? But what if it's not a little bit below, but you can't really say it's far below either? It's kind of in the middle. A little bit below is almost touching, just hovering just beneath the 20. But what if it's a little deeper than that, but it's not quite, and it's not quite reached the qualifications of being far below? Not far below, but it's not close either. That's in the middle. I call those, in reality, neutral zones is really not the right term, but it's in the middle. And that middle zone is the medium zone. So there's the light zone a little bit. There's the light to medium a little bit below. Then there's the pure medium that's not close, but not far. Then there's the far, medium to heavy. And then there's the far, that's pure heavy. And so there are different grades of being below, and vice versa on the short side, different grades of being way above or being above the 20. All right. There is one neutral zone that I think is important to understand, and this is truly a neutral zone, and it is above the 20. So here's your 20-period moving average, and you got 1, you've got 2, you've got 3, and you've got 4, right? 5 is way above, and 5 is profit-taking zone from a long or buy perspective. So we take profits in location fives. We think about buying in this zone, but we think about lightening up in 5. So if we think about the cycle, you see, you're coming into your swing trade. Sometimes this is deeper. And you're always thinking about lightening up or getting out on the move away from your 20. Distance from your 20-period moving average. Space, a decent amount of space between your stock and its 20-period moving average. A decent amount of space between the stock and your original entry point. A decent amount of space between the stock and its prior peak. All of these things matter to come into play. All of these things define location 5. Space between your stock and your 20. Space between your stock and your original entry point. Space between the stock and its prior peak. When you have space between all of those, you are in location 5. Is that a neat little way to define for you whether you're in 5 or not? The 3 spaces? Do you got that? Do you understand? Space, distance between your original entry point and the location of the stock. Space, distance between the stock and the 20. Space, distance between the stock and its prior peak. Talk to me. Tell me you understand that. Or not. All right. Ken, you're saying 5 says heavy, medium to heavy buy? No, it doesn't. It says medium to heavy. It doesn't say buy, though. So, yes, location 5 is a sell location. Location 5 can only be a sell location. Can I quantify? See, this is the mindset of a mathematician and not a trader. No. I do not want you to think mathematically about this, believe it or not. There is no percentage. Right? This takes a lot of traders down the wrong path thinking this way. They want to fit the market into a specific mathematical box. And it doesn't work that way. It has to be visual. In one play, it might be way smaller than in another play. Location 5 might be a much smaller gain in QCOM than it is in Home Depot. Because if you think about this, when you say, wow, relative to this stock and this price range and relative to the shape and contours of its trend, it is now in location 5. It's far, it's got distance between my entry and where it is, the 20 and where it is, and the prior peak. but it might take more from another stock to get there. So for instance, let's say for instance, this is you entered here and you have distance from your entry. You've got distance from your prior peak. You've got distance from your 20. That's it. But that is different from, look at this one. You see, based on this peak, you can potentially reach 5 much faster. It takes a longer way to really qualify as 5 on this particular setup than this particular setup. So you don't want percentages. It's tailored for every play, every stock, every price range, every shape, every type of pattern, every type of trend, every type of former peak. And that's, you want it fluid like that. You want it real like that. You don't want a blanket number or percentage applied to the entire world of the market. All right. All right. So why don't we do this before I go into the specific text? Let's just look at, if I can, I'm going to take the screen off just for a moment. What did I do here? And that's me removing the screen. Don't worry. What I'm going to do is let's do a different tab here. Let's do this. All right. Okay. Pull up the chart again here for you. Okay. Let's go over, let's do a mini quiz here. Okay. And just a few of you answer, that's fine. Just a few is fine. Okay. What's this? Give me a number. Let's break our stages down. What's this? 1. Excellent. What's this? Okay. Okay. And this? No, that's not 4. This is 4. This is 1. All right. What's this? That's right. It's a 3. So you see, you in order to play this correctly, you've got to sort of almost, not entirely, but you've got to ignore the past to a certain extent, not entirely. So, and of course, we're using Monday morning quarterbacking to judge this, but okay. So, what location is this? 1, 2, 3, 4, 5. 5. What location? Yeah, closer to 4 than anything, right? Space, distance. All right, good. All right, some of these things. What location? One, two, three, or 4. Right, you'd say that's 4. It's a little, it's close. It's not, you can't say that's far below, you know, but it's below. So it's closer to 3. What location? 1 on it, 2 slightly above it, 3, 4, or 5. Yeah, you say 1 if you want to say, just touching it. All right, cool. All right, just a few of you. Give me the location. All right, yes. And this would be closer to 4. All right, closer. 4 than anything, okay? Okay, and you get this. Distance. Distance. Now, so let me ask you something. If you are in location 4, you have gotten to location 4, okay? What color in location 4 do you think you need before having interest in location 4? It's not the location 4 by itself, right? You now need green to occur in location 4. Do you see what I'm saying? See, when I teach traders this, there's a tendency for the novice to say, oh, wow, locations, that's everything. No, it's part of it. It's an important part, but it is not. You can't catch falling knives. You are going to get murdered, killed. You can't catch falling safes that fall from the 80th floor and you try to catch a safe. No, the safe or the knife must bottom first, then go pick up the knife. The safe must hit the ground first, then go to the safe. Don't try to catch it, let it fall. Let the knife drop and stick in the floor. Then go walk over to the knife. After it has stuck in the floor, it's not going down anymore, it's hit bottom, then pick up the knife. Or let the safe hit the ground first. Then go to the safe and open it with the combination. So the way we do this, you don't try to guess where 4 is going to bottom. You must wait for, now that you are in 4, you now must wait for green to materialize in 4. And that's when you're ready to act. Now, here's something very important. Green sometimes hides from you. You see, green, if I tell most traders, show me green, show me where green occurred in location 4, you say that's easy. It occurred right there. And that's not entirely wrong, but that's not where it first occurred. Green first occurred right here, but it's hiding from you. You see, this was red, right? At the low. This looked like this at the low tick. This is how the bar looked. But it ended here, which means that you had movement up from the low. All movement up is the color green. So your first green bar is right there. Do you see that? Do you see that? Do you understand that? All right. Sometimes in our swing trading plays, we are going to enter on the hidden part of the first part of green. Sometimes. Now, there's a tendency for the traders to feel like, Oliver, but isn't that a little riskier? Well, not really. It's a little safer. Because look at where your stop is. Versus you buy here and look at where your stop is. Which one's safer to you? Falling from here to here or here to there? The anticipatory approach you do sometimes when it's safer, and a lot of times it is. There's a price for being just a little bit more short. There's a price to pay for just when it's just waiting for when it's just a little bit more obvious, and the price you pay is a higher price. And when you're wrong, you pay the price of losing more. Do you want the comfort of knowing that it's a little more certain? Waiting for a little bit more information, trying to be a little more sure, then yes, you can do that, but you're going to pay up for that. Okay? All right. The same thing in reverse. If we need green in location 4, what do we need in location 5? We need red. We don't just gas in location 5 where the top is going to be. We need red to materialize and form in location 5. And then we're ready for a possible play to the downside. Guys, I used to make a living swing trading. All right? Late 80s, early 1990s. It was my predominant style of market play. And I was, by 91, 92, I was deadly. One of the ways I made a living was really on the short side. Most professionals make most of their money on the short side. And it makes sense. It's devoid of novices because novices don't short, especially back then. And when you got movements down, they were faster, harder, and you made your money in gushes, you know. But one of the tactics I used was simply this concept I'm teaching you here. FAR extension and the elimination of 1/3 to 1/2 of former green. So you've got green in location 5. At what point does 1/3 of the green get eliminated? I would hit that point up, boom, with a stop above the high. And there are times, this is what I would call putting my toe in the water. I'm going to put my toe in. My toe was always the 1/3 mark. I would sink my whole body in at the halfway mark. Boom. So when I was wrong a lot of times, I'd be wrong with my toe and I'd get out and then try it again. The next time, 1/3 of a solid green in a high extended point, put my toe in, that's the normal. And then boom, the 50 was the heavy. And I made a living with this tactic. Predominantly location 5 tactic. And I made a living. Every week, every month, every quarter. And remember, swing trading, all I was looking for is a multi-bar move to the downside. You know? In an overall bear market? No, not necessarily in an overall bear market. You know, I couldn't make a living waiting for the bear market. You know, in a bull market, it's 3 years. I want 3 years with no living? No, not always. Remember, if you're not looking for an avalanche or the world to end, like most novices do, and you're only looking for a multi-day pop, can you get a multi-day pop to the downside in a bull market? Do those happen? How frequently does a 2 to 5 bar move down happen in a bull market? Frequently? Oh, you bet. All the time. Not looking for, but again, it's better to play. It's better to play within your stage. Always. But this is how I made my living. And I did it on the long side. It's just that I made more on the short side. All right. And does it still work today? Absolutely. The concept is universal and it's timeless. All right. Universal and timeless. Of course, you can see here, you're in just a really solid stage 2. Guys, I want to go over this again. Don't let me forget this. DD here. This is a specific event I need to teach you. That's a perfect example of it here. All right. Here's something interesting here. Disney, at least from the medium term view or the swing trading view, you've got your 3 here. Unless something radically changes, you know. And you know, if this gets taken out, we're looking for more downside here, but and so I just want you to get used to looking at things in through the eyes of location. You know, we're not looking at enough data to get a lot of different locations in one stock, but you know, look at it in terms of location. You're near, you're far, you're far. You know, you're far, you're 4, and then here's your green. You know, look, location and color change. Location and color change. Far and green. Far and red. You know, I want you to get used to that. That is what's going to build your opportunity spotting skills. This is interesting here. We'll cover that. What you're on here. Here. You're on here. You're just above here. You're on here. Get used to the locations. A little bit extended. You don't want to be a buyer here. I'm not saying you're a shorter there either. You just don't want to be a buyer there. And if it even goes up from there, it's just not your money. That's not the kind of money you make. It's not about grabbing every single dollar or every amount of money, every and all amounts of money that are available out there. You know, that would be akin to saying, well, make money any way you want to. Sell crack cocaine, sell things, steal things and sell them illegally. That's money. But no. You don't want that kind of money. That's dirty money. There's dirty money in the market. There's stupid money in the market. Like someone who buys way up here and makes money is dumb. All right? It doesn't mean, and they're going to feel the pain of that stupidity over time. They got lucky this time. There's certain types of money you don't want. You don't want to make money the wrong way because it is going to come back to bite you. Interesting here. We'll talk about that. It's called the topping tail bar takeout, which I have to get to in just a bit here. All right, on. Get used to looking at right above. On. Get used to looking at things through the eyes of location. Okay? Through the eyes of location. Where was your green? Right here, right? Get used to looking at things through the eyes of location. And sometimes it's just slop. That's fine. You'll know slop when you see it. But we want to be concerned with most of the things that are swinging at the time. See, this is a swing. This is a swing. This is slop. Right? That's not obviously a candidate for us. When you're swing trading, you need a stock that is in swing mode. It's moving away from the 20 to the upside. It's moving away from the 20 to the downside. It's swinging. There are swings in the park that nobody's on that are not swinging. They're standing still. That's not what you want. You don't want a stock that's not swinging. Nobody's on it. Nobody's pushing it. You focus on, oh, okay, this one's not moving. That one's not moving. Okay, this one's swinging. That's your candidates. That's how you take a list of the Dow. Out of the Dow 30, how many stocks are swinging right now? And how many stocks are stuck in there? Nobody's on them pushing them. Like I'll show you. You know, nobody's really on this pushing this. The wind or the breeze sometimes moves the swing a little bit, but it's not really swinging. You would get eaten up alive to try to swing trade this. All right. Make sense, guys? Just want to make sure you're still with me. Make sure you understand. All right. Okay. Let me take the screen off. And put a slide back up. And we are going to go to heart of everything, now that we have the foundational cornerstones in place of cycle and the different phases or stages of the cycle and the transitional points of the cycle, the baton passing, the location concepts of 5 and 4, and the cluster around the 20-period moving average 1, 2, and 3, and the changing of color concept of average 1, 2, and 3, and the changing of color concept when you are particularly in location 4 and 5, and how the color can hide from you inside the same bar and look like it happens later, but it started to happen earlier. We've got that down, okay? Now, let's go to the specific individual events that I want you to become an expert at identifying and exploiting. These events, when they happen in the right locations, are very powerful. These are your baton passing events. These are your transitional events from one mode or one state or one mood in your stock to the next. You become an expert at identifying and exploiting these, and you'll be in this business for a very long time, perhaps even forever. Okay? Now, the first thing, tail bars, you guys most of you guys who follow me know them. You know them well. I'm going to, and some of these I found that to teach them, to draw them in front of you, that's why I have the blank slides. Some of them I'm not going to draw just to save time, but I find that when we draw together, that you retain better. All right. And this is backed up by studies. So, and I have so many of these already made for you, as you know. But for some reason, you do better this way. A tail bar is made up of, in the candlestick world, it is made up of a tail on the end of the bar with either a red box on top, all right, a green box on top, or a no color top. Now, this no color can be here all the way to maybe there. But it cannot be here. This is not a tail bar. You understand? So a bottoming tail can be here in this upper, I would say the upper third range of the bar. This box cannot be here. That is not a tail bar. And many of you call it so, but it's not. It can be here all the way to about the 1/3 mark to be truly a tail bar. Same for the red. All right? That's not a tail bar. Even halfway is not a tail bar. One-third is really officially, you want the tail to represent 2/3 or more of the bar's range to be a true, powerful, authentic tail bar. Some of you call any wick a tail bar, and you still do it. As much as I pointed out, you still do it. Okay? There are wicks and there are tails. This is a tail. This is a wick. All right, that's even a wick. That's not a tail. This is a tail. Okay, so these are the three types of bottoming tail bars. Of course, reverse them for topping tail bars. Okay, and you just reverse. See? And it's the same. Now, it's very clear and easy what we do or how we take advantage of these. There are two ways. When you get a bottoming tail bar in, let's say, like a location 4, you can do the anticipatory buy, which is to buy the actual tail bar. But if you do this, this must be done in the last 5 minutes, the last 10 minutes of trading on the daily bar. So you notice that a stock you're focusing on is in location 4, and today is almost finished trading. You're almost at the end of the day, and it has formed a nice, powerful bottoming tail bar in location 4. You can buy the anticipatory buy. Why? Because a tail bar is a green bar hiding from you. That's what this is. This one is a green bar that has not quite gotten all the way back to the top. This is a green bar that has gotten all the way to the top and some. And this is a green bar similar to the first, not closing all the way at the top, but still 2/3 or more of the bar's range is a green bar hiding from you in the form of a tail. It's an elephant that is trying to tiptoe past you, and you can buy the elephant. This is the anticipatory buy. Your stop reference point is under the low of the tail. All right? That's the anticipatory buy. The non-anticipatory buy is to buy the first, at the moment the stock clears the high of your tail bar, whichever version you have. That is your non-anticipatory, the clearing of the high, or the anticipatory buy. In both cases, your stops reference point is under the bottoming tail bar's low. Now again, this is all in the context of your location. So tail bar here, it's 4. Tail bar here, this is 2. Tail bar here, this is location 1, it's on it. Tail bar here, this is location 3, it's just below it. And then you have the bottoming tail bar here, which trips some people up. It's in location 5, but it's a bottoming tail bar. What if you clear this? Is that a buy? No, 5 is never a buy. 5 can only be a sell. In fact, if you get a bottoming tail bar in location 5, that is a bearish sign. And if you break the low, that can be a short. It's called a bottoming tail bar takeout, which I'm going to cover shortly. All right. But this can be, so you drop down to here. This can be a light buy, or you drop down to here. This can be a light buy, or you drop down even lower to here. This can be a light buy, light to medium buy. You drop down all the way to here. And this can be a medium to heavy, even deeper heavy. All right. So event one, transition one is this. And most of you know this, but it's this followed, I did it again. It's this followed by this. That's what a tail bar is, but consolidated into one movement. It drops, then comes back, most of the way, or all of the way, depending upon the type. And that come back off the low, that explosion off the low in an oversold zone is what we're looking to capture. It's the rush back to the upside. It's the snapback. It's the moment your rubber band stops being pulled backwards. And it's the moment of release where the rubber band for the first time in a while starts to propel the rock forward. Boom. This is the first part you grab. All right? All right. Okay. Oliver, I need a clarification. I understand you can short swing in a bull market. When we're as good as you, but I thought you were emphasizing swing concept now because we're getting ready to move from abuse to bear. Yeah, but you understand I'm speaking of macro stages. You're making this a lot more complex than it really has to be. You're overthinking it. When we're talking about us being here, you could be here for a year. You understand? You could be there for a year in that transitional pit. This is macro. You could be down here in 2020. This is macro. And in this zone, you're going to have stocks that look like this, stocks that look like this, stocks that look like this. This is the macro part of the cycle of the overall market. You can still find stocks that look like that will be doing that. Clarify it. Don't overthink. All right. So item number one. Okay. Tail bars in the right locations. Item number two. Tail bars. All right. You know them. What I call elephants. These are elephant events. They are the same. Now, this is going to be interesting because you guys really need a powerful refresher on this. This is the bull elephant, and this is the bear elephant, right? Now, what this is simply a power move off the low. It's power, velocity, enormous strength, push with force. Same thing to the downside here. Now, in a sense, it's the same as the bottoming tail bar, but it's the right side of the bottoming tail bar. You see, the bottoming tail bar is first down And then within the same period, shoot, I did it again. It's first to move down. In the same period, it is a snap back to create the tail. So in a sense, the elephant is this side of it. If we forgot the fact that it got down to this point here and just looked at the snapback, we just see it as an elephant. All right? But both sides of this, the right side of your tail bar and the elephant itself, it's really the same move up, the thrust upward. That thrust upward in the right location, off the 20, from below the 20, deep below the 20, that's what we're looking for. We're looking for an abnormal thrust, an abnormal jump to the upside, an abnormal amount of velocity in that direction. But it must originate from one of the key locations. Same thing on the downside. Okay, if this happens and this is location 5, I'm probably in trouble. Right? You're way up there in Pluto land, probably in trouble. All right. Now, so elephants in the right location, originating. Understand that the origination point is important. The origination point of your elephant, the origination point of your tail. Important. Not only are they reference points for your stop, they mark the location as well. The far end of your location. Where did this thrust to the upside originate? Did it originate out of a 4? Did it originate off the 20-period moving average? Even in location 5, check this out, guys. Even in location 5, here's an elephant. This originated right off the 20. But look at this one. This one is an elephant. This is an elephant and this is an elephant, but this is in location 5 and this is in location 2, right off the 20. But it originated in location 5, which makes it a bearish event. As bullish as it is, it's a bearish event. Yeah. Have you ever seen a race? A few of you just give me yes or no. Have you ever seen a race where this runner has gone such a long way, almost can't make it, visibly exhausted, tired, maybe even cramping up, but they know they're close, and all of a sudden, out of nowhere, something just kicks in and they just put it all on the line, and they're in the final stretch, and you can see that all of a sudden everything's picked up. It's like they got their second win, and it's like, oh my God, it's like a different runner. but you know they're almost destroyed, but there's some, they've dug deep. Now they're running fast or whatever. You can see the pain on their face or whatever. When they cross that finish line after that, what do they typically do? Collapse. That's what this is. That last hurrah into the finish line, that digging deep one last time to give it all you've got before it's over, the race is over. And usually, this is next. Originates in location 5, bearish. Originates, all the bullish locations are down here. All the bearish locations are up there. So what can be bullish here can be bearish in location 5 if it originates up there. The same thing, guys, with this. This originates in location 5. It's a bottoming tail bar, but down here, okay, but up here, no. That's bearish. This is a potential sell. So in a sense, your location flavors the event. Your location labels the event, bullish or bearish, not the event itself. The event itself is kind of neutral. It's the location that paints it with a bullish brush or a bearish brush. If you keep this point in mind, you won't ever really go wrong with it as to why something you generically look at as bullish is now bearish. Location determines bullishness or bearishness, not the event itself. All right. So we've got tails. We've got elephants. Now, let's go to the elephants. Let's go to what you, as you know, many of you know as the 180 setups. All right. These are 180s. I call them 180s because they produce 180-degree turns of something that happened before it. So remember that the tail bar is made up of two sides, a downward movement and then an upward movement, but all inside of the same bar. You see? To leave behind a tail or a shadow of where the bearishness used to be. When it happens separate, it's called a bear 180. So instead of the move down and the move up occurring in one bar, the move down is in one bar and the move back up is in a separate bar. And so in a sense, the bull 180 is a delayed bottoming tail bar. It's just that the move up did not happen in the same bar. It happened a little bit later. And the up move happened one bar later. So is it the same power as the tail bar if in truth it's the same? That's a question I get a lot. And the answer is no, this is more powerful. So a lot of traders will say, well, Oliver, if it's almost the same, how is it more powerful? Because it's delayed. For whatever reason, the delayed version of things garners and gathers and saves up more power. So think of just more time to happen means more time to garner more power. So when you rate these, a bull 180 is more powerful than a bottoming tail bar, although you always play them both. You just might play the bull 180 heavier. It's not that you choose. Don't ever choose between what I'm teaching you. The tactics I'm teaching you are to be exploited. It's just that I want you to know which ones have greater power than the others, but they're all powerful. It's just a matter of degree. They're all great athletes. They all are above average, way above average. You don't choose amongst them. You play them all. You might play one or two just a little bit more aggressively. So we buy at the point that the green bar surpasses the red bar. What this is a fairly sizable, steep, deep bear elephant bar that is followed immediately by an even more powerful bull elephant bar that takes out the high. Your buy to exploit is above the high. Your stop is below the low. Now, remember I told you that the topping tail bar has an anticipatory entry version, which you can buy at toward the end of the bar before the bar finishes, as long as you're buying in the upper third part of the bar's range. Or you can wait for the confirmation buy. I have to tell you that the same thing exists for the elephant bar, where you can buy if it's in the last 5 or 10 minutes of the trading day, and you have this elephant bar in the right location. You can buy in that bar last 5 to 10 minutes, or you can buy the following day if you get follow through on that bar. You see? Some people say, well, Oliver, the difference between the anticipatory here on my elephant and the confirming buy is not big. Here on my elephant and the confirming buy is not big. But the only reason why some traders do the anticipatory is because of the gap potential in the elephants. The elephants can lead to gap opens in the morning. So they want to try to grab this tendency. Okay? So what's the anticipatory version of, we know the confirming version is here, crossing the high. What's the anticipatory version? In the upper 10% range. All right? So here's the anticipatory version of it. I wanted almost all of the red taken out, but not quite. Then that's okay to anticipate it there. If you want to try to jump the gun a little bit and gain an edge, it may end right there. That's still fine. This is so powerful that if they almost take out the high, they're still just as powerful. All right, so you have the anticipatory buy right as it's taken out the vast majority of red, or the confirming buy on your bull 80 when it actually does take out the high of the red bar. Stop below the low. All right, stop reference point below the low. Okay. The reverse goes for the bear 180, as you know. So we have, so far, tail bars in their right locations. Elephant bars in the right location. Anticipatory buy and confirming buy. Anticipatory buy and confirming buy. And we have the bull 180s, anticipatory buy, and they're confirming buys. The next item on the list, the fourth item that I want you to be able to identify and exploit, they're called red bar takeouts. Very important. In a sense, they are delayed Bull 180. See, this Bull 180 is the immediate version. This is the delayed version of the Bull 180. The key to both the Bull 180 and the delayed red bar takeout is that there is no follow through or little to no follow through on either one. Please understand that that is the most important concept of all. The less important concept is when the red is taken out by the green, whether it's immediate or delayed later, is less important than the little to no follow through. It's this immediate comeback after the red that is the key. The failure of the bears to produce more than this. The pushback so violently by the bulls that they turn the whole ship around. That's the important thing. But after no follow through, no follow through. Solid. This type of bar is so powerful that you expect more red. But to have almost no red, additional red at all, and this 100% wipe out this bar, 100% wipe out this bar eventually, is to say that this bar is the fake. That bar tried to make you think that that was where the power was, but the power is really here. You go with this side. So whether it's immediate, boom, or delayed, really doesn't make a difference. I do split it into a separate category. I call it a red bar takeout versus a Bull 180. Bull 180 is immediate, red bar takeout is delayed. The common denominator being little to no follow through. I wouldn't do an anticipatory version on the red bar takeout. I would do it on the immediate. But the delayed version, I really wouldn't. I just wait for it to cross and boom, that's my entry. Your stop on the delayed can be one of two places when you're swinging with this. When you enter, your stop can be under the entered bar, but that depends on what type of bar crosses it. Because in truth, nothing is wrong until your red bar starts to produce follow through. Even if this came back in from here, it's not all that serious. But if this starts to produce follow through, late follow through, or follow through albeit being late, that's trouble. So it depends. Sometimes you're going to put your stop here. Sometimes you're going to put your stop there. But I would not, and if this is a bull elephant bar, I'm okay with your stop being a little tighter. What I'm not okay with is if this is the type of bar that crossed it. You see? Now you're not going to enter here and put your stop there. Too tight. And many novice traders make this error. They think that the tighter the stop, the better, when it's really the reverse. The wider the stop, the better, but wider within the confines of intelligence, not wide for the sake of wide. But whenever you have the choice between one or two stops, You always default to the wider one, not the narrower one. Novices revert to the narrow one. Pros revert to the widest one as long as the widest one is intelligent within the confines of intelligence, not just wide because of just for the sake of being wide. It's a smart wider. It's wider. It's not wide. It's wider than another option, but it's smart. How are we doing? Are you following this? Are you getting this? We've got 1, 2, 3. We've got 4 swing events right now. All right. We've got the bottoming tail bar event in the right location. We've got the elephant bar event in the right location. We've got the bull 180 in the right location. We've got the delayed bull 180, which we're calling a red bar takeout, in the right direction. Let's quickly go over let's look at a few of these if we can. Look at this very carefully. Look at this. I'm just going to point a few out really fast. Look at this bull 180 right off the 20. All right. Look at this bull 180 right off the 20, but this is the anticipatory one. See? It didn't quite clear the high of the red. And that's in location 4. Look at the bottoming tail bar in location 1 on. All right. Look at the bottoming tail bar in location 4. Anticipatory buy here. No, anticipatory buy there. Confirming buy there because you're buying toward the end of the day, right? Even before, in a sense, your bottoming tail bar, you had the almost bare bull 180. But look at your bottoming tail bar on the 20. Look at your bottoming tail bar on the 20. Look at your elephant bar right on top of the 20. And really what you have here is a transition from a 4 to a 1 back to a 2. And all in here is your transitional. Let me do that thicker. Right? Look at this. So remember I told you the best opportunities come here. The transition. So here's the 1. I said sometimes we'll grab the 1. And then all of these, this bull elephant bar, this tail bar, all of this come in that transition right before 1 becomes 2. And that's where you see the proliferation of those occurring a lot of times. It's a beautiful thing. Bottoming tail bar. Bull elephant bar on. All right. Not quite a pure bottoming tail bar, but bottoming tail bar right above. Bull 180. Not quite clearing the high, but that's close enough. 180. I mean, bull elephant bar. I'm sorry. Bottoming tail bar. Bull 180 solid red, no follow through. Green takes out almost all of the red. And this marks your bottom. Look at this one. Red takes out the red right on the 20. Bottoming tail bar right on the 20. All right, same things here, guys. You're looking, just get used to looking at things at the locations. Bottoming tail bar on the 20. All right. What we're going to get to next is this. This is called a topping tail bar takeout. See? That is a buy event. And let's cover that right now, if we can. That is a buy event. The topping tail takeout. So we have the tail bar. We have the tail bar. We have the elephant bar. Let me call it a breakout. Topping tail breakout. So this is what it looks like. It looks like this. You're dropping, you're dropping, you're dropping, you're dropping. And then you get a push up. But then it comes back. Now that's a topping tail bar right there. See? It pushed up, but then it fell all the way back. Now, just like with the Bear 180 and the red bar takeout, if this topping tail does not produce any more downside to speak of, and it either gets the tail taken out right away, see, or in a delayed version, in a delayed fashion. All right. Either immediate, just like the Bull 180 is immediate, and the red bar takeout is delayed. You can get the immediate takeout of the topping tail or a delayed takeout of the topping tail. And it's a buy, either version. Now, again, what this really is a derivative of the Bull 180, because this move down represents your red bar. You see? Immediate, Bull 180, later, red bar takeout. It's the same, it's just hiding from you. Do you understand that, at least intellectually? Do you see that? Just a few of you let me know. Okay. So we want topping tail bars. Now, guys, there's a reason why this is important and why it's so significant. You see, the Bears were in control here. But for the first time, you saw a push of greater force by the Bulls. It didn't last, but it's like their first sign that they are fighting back now. We're fighting back here. But it's their first time that they're ready to fight back now. So I always explain it to my kids like, you ever hit the alarm? You hit the alarm and you hit the snooze button. But you know it's really close. You got to get up. Another 5 minutes, another 10 minutes, but you got to get up. This is like, man, they woke up. Ugh, okay. All right, guys. Time to go fight now. All right. They hit the snooze button for a little bit. They came back in, but they're gonna fight now and come back. So topping tail bars after declines are powerful in the same fashion that bottoming tail bars after rallies are powerful bear signals. We're in location 5 now, right? And then boom. This is your first sign that they rushed, that they could push deep back. Boom. It didn't last. It drifted back up. But it's starting to show. They're starting to show that they can push back now. You see? The bears can push back, and it's happening in location 5. So in a sense, this is your green bar that's floated back up, but it's a weak green bar because the push down was deep. So it drifted back up to form the green bar. And if you don't have to, but if this starts to happen, remember I used to make a living off this. Nibble to 1/3, go in past, heavy past the 1/2. And you know that when you go all the way, that's your bear 180. And this thing should just be lowered 6 feet under. So I would catch some bear 180s very early with the 1/3 concept, the 1/2, more than 1/2 concept. But this is when you have it all, when you know that, okay, major amount of green erased in location 5, we've got space to fall. Powerful. Powerful. So we have covered tail bars, anticipatory entries, confirming entries, stops. Elephant bars, anticipatory entries last 5 to 10 minutes of the trading day. Confirming entries, stops. $180s, solid red, no follow through or little to no follow through. Immediate snapback, break the high, enter, stop below the low of the entire 2-bar pattern. Delayed red bar takeouts. Okay. Solid red bar, no follow through. Drift back up and later take out the high. Enter. Sometimes the stop can be below the low if the entry bar is an elephant bar. You put the stop. Otherwise, your stop goes under the entire pattern because in truth, this is really just one bar sliced up over time. Powerful. And then we talked about the topping tail or takeout. The two versions, the immediate version and the delayed version. All right. Here we go. Here's your delayed version. Breaks the high immediately, breaks the high later, no follow, breaks the high later, no follow through on both. Powerful. Topping tail bar takeout is best far below the 20 MA location. Everything buy is best below, far below the 20 MA, not just that one. But yes, the answer is yes. This works well after a deep pullback. But don't limit it to that. This drop in your tail bar shakes a lot of traders. A lot of traders cough up their valuable merchandise because this falls back. You know? And as soon as they empty their pockets, you know, this falls back. As soon as they empty their pockets, cruel, right? But necessary. So we have tails, elephants. Get used to saying this. Tails, elephants, 180s, red bar takeouts, topping bar takeouts, the immediate. So you got 180s, the immediate and the delayed. The delayed is called red bar takeouts. You got the topping tail takeout, the immediate version and the delayed version. All right. So we've got tails, that's one. Elephants, that's two. 180s, that's three. Red bar takeouts, that's four. Topping tail bar takeouts, that's five. Delayed topping bar takeouts, I kind of come 5A or whatever, or 6 if you want. It doesn't matter what the number is. And the next item are breakouts. As a swing trading opportunity. You have to always include breakouts in your possibilities, because this is how you play this. You see? That happens. Or this. All right? Now, the key to playing breakouts appropriately, these are the two types that you get, the breakouts from a bottom and the breakouts from a pause in an ongoing uptrend. The key to both is that you should really limit your buying of breakouts to those that are coming out of narrow sideways movements. The wider your sideways movements, the higher it is susceptible to failure. So you want narrow. pauses, narrow sideways movement, tight. You want the vast majority of the bars to be small that make up this sideways tight scenario. If you do that, you're going to be a far more accurate breakout player than most traders are, because most traders believe that any breakout's buyable. Like, it doesn't matter what was the nature of the sideways movement before it. But remember, the breakout is being born from this period. This is the birthplace of your breakout. If this is sloppy, your breakout will be sloppy, will tend to be sloppy. If this is muddy and just wild and whipping and unpredictable, that will tend to be the characteristic of your breakout. But if it's calm, tight, narrow, controlled, contained, then it breaks out. It breaks out from a source like a powder keg. It's an explosion from a tight, narrow place that was just full of pent up dynamite, pent up power. You know, you spring from it. The biggest explosion comes from an atom. You spring from this small item, explode from this small item. You know, the blow from a contracted fist is more powerful from a wide open hand. You know, nature packs its power into small packages. The market is nothing more than an additional mirror of nature. It's the same. I've taught you on the equity side in the micro trading mode that the market's biggest bars are born from its smallest bars, and in a way, the breakout is the same. This big bar is born from a collection of little bars that form a sideways movement. All right? So we want to, when a stock is pausing and it's tight, you kind of think breakout more than you think breakdown. That doesn't mean breakdown can't happen, but breakdowns tend to happen more from wide and whippy than tight and narrow. That's usually a pause and not a top. Tops are wide and whippy. Pauses are tight and narrow. So be careful. Another reason why this makes sense, that wide and whippy, because if you're wide and whippy, right, by the time you break out, look at how far you've run. Now you're expecting this to be the beginning when really the beginning was here. So you buy what you think is the beginning of a brand new move, but it was at the tired point because it really originated here. But that is not the same as this, you see? Now, when this breaks out, it truly is just starting. It didn't come from here to try to now start a brand new move. It's truly a brand new move. So limit your breakouts to tight sideways movements, okay? And that creates your average 6. Now, the only other thing I will add about how you swing trade breakouts is that you don't need the upper part to break. This is not your breakout point. It's the last 3/3 of your base. So that's what I tell traders to do. Your sideways movement usually doesn't happen right at the tippy top. It does sometimes, but that's not the norm. It usually happens a little bit off behind. Now, look at this move sideways as an elephant bar laying on its back. So if you were to tip this back this way, right, it would just look like this. It's just laying down now, right? So if I told you that clearing almost all of the red was good enough that you don't always have to wait for all of it to clear. If this anticipatory is good enough, then I want you to, okay, when the clearing of the last 2/3, so even if you had like a little bit of a higher here and a little bit higher here, as long as the last 2/3 of this base, not all the way, just this part, as long as you're clearing that, even if there's some peaks a little bit higher here, think this concept, you see? I'm clearing the majority of it. I'm not clearing this one, but I'm clearing the majority. That's good enough entry point right there. And remember, in most cases, your anticipatory one early is just going to keep your stop tighter anyway, which goes under the base. Understand? Breakouts? Okay. All right. So we have, what are our items? We have tails, 180s, no, elephants, 180s, bull and bear, elephants, bull and bear, tails, topping and bottoming and topping. You have red bar takeouts. That's the delayed version of the 80s. You have topping tail takeouts and the delayed. Okay, immediate and delayed. You have the breakouts from narrow bases, tight narrow bases. And so really, if we split this into its separate number, right? Topping tail takeout delayed, like we've done for the 180, and the breakouts. Here are your seven main events. Now, I want to cover event 8, which is the add event, RBI, GBI, right? You guys know what that is. And if we go back to, many of you know what that is, but if we go back to the charts for a moment, I'm going to bring up a chart here, and I want to flip through again. If it'll let me, it looks like I'm frozen here. There we go. I want to flip through let me grab, I'm going to grab an index. index here. Grab the NASDAQ 100. I'll flip through. My goodness. It's making me sign in again. Sorry about this here, guys. Okay. And pull up the NASDAQ 100. And so, let me get your chart posted here. The RBI, as many of you know, is the quintessential add event. Sometimes it's an entry event. So, for instance, here it might be an entry event where you have one single red bar. It is flanked by, on either side, by green. The bar before it was green. The bar immediately after it is green, and its high gets taken out. Now listen to these words again. It is a single red bar flanked by green. There's a green bar to the left of this red bar, and there's a green bar to the right of this red bar. And as long as you have that scenario, when the high of the red bar is taken out, it's a buy. Of course, in the right location. Now, the reason why I explain it that way is because the high of the red bar doesn't, remember there's always that immediate version and a delayed version. So the immediate version is that the very next bar after red is the takeout bar too. Boom, as it is in this case. But it's possible for this to be a little green bar and the next bar to be the takeout bar. Or the next bar. There are delayed versions, but as long as this red, the lower the red bar is not taken out, as long as it hangs here and then takes it out, it qualifies as the single red bar takeout, the red bar ignored. So it can be delayed, it just can't produce more red. All right? And this is typically a good single red flanked by green. Green on the left, green on the right. Okay? Single red bar flanked by green. Green on the left, green on the right. In this case, the green on the right is not the trigger. The trigger is the next bar. Boom. Oh, do we have a location? Yes, location 1. Right on the 20. This is a key buy. Boom. All right. Topping tail bar takeout. Maybe that's considered a little bit too high for you, but there you go. Boom. All right. And guys, what my tactics do is when you practice recognizing them, single red bar flanked by green, green on the left, green on the right. The one immediately on the right takes out the high. That's your entry. Do we have right location? Yes, location 2, right above the 20. They train you to, if you practice identifying these, you get trained to read market behavior so well. The locations just draw you to where you're supposed to be focused on. The locations force you to be, what's the most popular market saying or axiom you've You've heard the most popular one, the one they say, how do you play the market? You do what? You buy where? It's the one that everybody knows, even the people who don't play the market. You buy low and you sell high. That's the axiom that everybody repeats, right? And it's true. It's how you make money. You buy low, you sell high. Easier said than done, of course. Now, can you buy high with my approach, with the location approach? Is it possible to buy high? No, you can't. No. You, it's it's just compels you to buy low. Now, of course, you can get stopped out. What you thought was low wound up being the middle. That's possible, yes. But you will never buy high, ever. No, never. A year from now, it might look like it's high, but it's not high at the moment you're acting. It's just impossible. The approach forces you to be a buy low, sell high. You are selling five. You are buying ones, twos, threes, and fours. But you are selling fives. You are selling rallies. You are selling at the point that the novices are becoming interested. Stock moves to a new high, well above the 20-period moving average. Most of the world new high. You're selling to them. It will train you to come into the market and to be interested at the right time, to think buy at the right time, to think maybe I should be lightening up at the right time. You will never be a buyer here. You see? That's not what you do once you learn this approach. You're not going to be a buyer here. Okay? You may be a buyer here. Why? Sideways, tight, narrow, small bars, not wide and whippy. Risk small, not way, way above the 20-period moving average. You might be a buyer here above the bottoming tail bar on the 20-period moving average. You see? You are forced, compelled. You might be a buyer here because it's a bull 180 right off of the 20-period moving average. You're not going to be a buyer here. It compels you to start becoming interested at the right time, not here. How beautiful is that? You bought the bottoming tail bar off the 20. You added on the RBI, single red bar, flanked by green. Green on the left, green on the right. This is the immediate version because the green on the right is your trigger bar. Boom. You forever will be able to look at any stock and see where the moments are to think about bottoming tail. Give it a shot here. Tight stop. Single red bar, flanked by green. Green on the left, green on the right. The immediate version, the green on the right, is your trigger bar. It's bull 180 under the 20. You give it a shot. Stop below the low. Okay? It's just, you know, I mean, and these are real rewards. We're not making this up, right? The thing is that I have spent nearly 3 decades isolating what really matters. You see, a lot of people think everything matters. And in fact, very little matters. Very little has importance. Most of this crap doesn't mean anything. It just means something at certain locations. All right? So this tail bar here means something now. You know? Look at this. Single red bar flanked by green, green, trigger. Single red bar flanked by green, green, trigger. You're right off in location 2, just above the 20. Okay? Decent, tight, narrow. Here's your clearing. Not wide and whippy, not big bars. But you get the point. Maybe I can do a little bit longer here. It's a little bit more data. Okay, you can see it a little further. Just pointing out locations here. But guys, you know, if you stick to your 2, see this is a 2, right? Now look for micro 4s in your 2s. Sometimes it's sideways, you see? But so sometimes your 4 is downward, and then sometimes your 4 is horizontal. And that's your breakout version of the 4. And this is your decline version of the 4 getting distance. All right? So then it just becomes, maybe I can go back to, now it just becomes capturing the moment of the 4s. This is too small. Not enough data. But this is where your odds, as Terry was pointing out, are obviously going to be better overall if you're just matching your trends, although it's still possible to do okay without it. You know, because you are going to have to get astute. So look at this here. You have dropped deep. You're deep. Now you don't get the bull 180 that goes all the way, but it's close enough. Like 90% of the red is there. That's a great anticipatory one. Stop here. You know? Sister stock there, so pretty much the same thing. Look at your 4 into your 1 into your 2 again. So when you start to get no follow through on solid red bars, look, solid red bar, no follow through. No follow through. Solid red bar, no follow through. Solid red bar, practically no follow through. You're bottoming. When the Bears produce a winning blow and then they quit, I mean, it's over. You got to go for the knockout, and you can't go for the knockout. You're just weak. So what I want to try to do is just keep pointing out very quickly, if I can. When a stock starts to RBI after a bottom, it's really powerful, meaning a single red. Boom. Single red. It's almost as if it's like when the Bears get the ball, all they can do is produce this little tiny red, and that's it. They give up. That's it. Like, you're kidding me. The ball was just passed to you, and that's all you can produce is this little red bar, and then you give the ball back? Like, they're so weak, The Bears are so weak, that's all they can produce. And that's the key with single red. That's all you can give me? That's it? That's it? Now you give it right back? That's all you can give me? That's it? That's it? And you give the ball right back? That's all you can give me? 1, and you give the ball right back? 1, and you give the ball right back? It's just a sign of power. Domination by the Bulls. So I call it RBIing. When a stock starts RBIing, you've got a winner on your hands. Now, you want to use those to beef up your play, but not so far away from the 20. All right. But good stuff, guys. This is good stuff. All right. Now, I'm going to do a very quick review. We've got tails as your actionable events in the right locations. You've got elephants as events in the right locations. You've got 180s as events in the right location. Red bar takeouts, which are delayed 180s, in the right locations. Topping tail bar takeouts in the right location. Delayed topping tail bar takeouts. Again, the key, no follow through after the topping tail. Breakouts, the key. That's really buying the move out of a 4 back into a 2. But this 4 is just laying on its back. It's not declining. It's sideways. It's tight. It's controlled. It's narrow. Boom. It's clearing, and it doesn't have to clear all the highs. It just has to clear the highs, the vast majority of the highs in that bar or in that sideways movement. And then there are your quintessential continuation events, the RBI and the reverse of that, which is the GBI. They can be entry events in the right location and or add events in the right location, as long as you're not adding close to location 5. And these events that start to, if a stock starts RBIing relatively frequently, you've got a big winner on your hands, typically. It's powerful when you put this together. There is one last concept before I give you a break and we go into our last leg. All right, one last concept. It is the concept of what I call for my micro traders double deep. It is a location more than it is an event. So what is double deep? Double deep is, I'm going to bring the slide now. Yes. Double deep is when your stock, this is the 20 period moving average, let's say, and your stock, let's say it's Apple. Your stock is deep below the 20. And your 20 is deep below the 200. Now, this is more of a major turning swing play, because in order to have this, you've got to be in a downtrend. Okay, so it's a counter trend play. Every trader needs a counter trend play. All right? You don't play it frequently or all the time, but you got to know how to know when it's smart to think about bucking the trend. Every master has that ability. Okay? It's usually not smart, but when it is, you've got to know when it is. And the double deep scenario is how I teach my traders to know when it's smart to think about bucking the trend. The double deep concept, or the name, comes from the fact that there are two layers of deepness. There's deep. The Apple is deep below its 20, or the stock is deep below its 20. The 20 is in turn deep below its item, which is the 200, and vice versa. You can have double deep or double penetration to the upside. Okay? Makes a stock more susceptible to collapsing. This makes a stock more susceptible to rocketing to the upside. Now, this is more of a location. Double deep is a location. Just like location 4 is far below the 20, well, double deep is not only location 4, it's location 4 plus. It's location 4 far below the 20, and the 20 is far below its 200. When you get any one of these items that occur in double deep territory, you can give it a shot. This is your buck the trend strategy, double deep. All right? But you can't just say, "Oh, we've got double deep. Let me try." No, you must have an event that I've taught you. A bottoming tail bar in double deep, go. A solid bull elephant bar, double deep, go. A bull 180 double deep, go. A red bar takeout, delayed bull 180, double deep, go. Topping tail bar takeout, double deep, go. Topping tail bar takeout, delayed version, go. All right, hard to get a breakout in double deep because double deep is usually more momentary. It's not like if it goes sideways long enough, that 20 period moving average catches up pretty quickly. So that's the rare one that will happen. An RBI in double deep. So you get a little push up, then a little pause bar red, and then boom! It's zipping to the upside. taking out the high of that pause red bar. And so this concept double D. That. All right. First target is normally at the 20, in between the 20 and 200, and then at the 300. I mean, at the 200. And these are your events. You combine these things with the right location, learn how to identify these things, you know how to exploit them, you know where your stop should be on them. This puts you in the game. This puts you in the game in a very big way. Always understanding that your sell points, your sell moments are as you approach 5. And I do want to cover some of that today. So what I'm going to do right now is we're gonna have to take another break. All right. And we're going to come back and we're going to talk a little bit about selling and managing your swing trade. Because once you know how to identify the event in its appropriate location and how you have two choices in most of them, anticipatory buy or the confirming buy, and where to place your initial stop under the base on the breakout, under the bottoming tail on the bottoming tail, under the elephant bar and the elephant bar, under the bull 180 and the bull 180, under the red bar takeout, under the red bar of the red bar takeout, under the topping tail bar of a topping tail bar takeout. It's basically under your event. Once you know how to identify your events in the right locations, which entries to take in, where to place the stops, the rest is made up of two components: profit taking and trade management before you profit take. Trade management involves adjustment of stops, your initial stop, trailing stops, and profit taking. So there's the adjustment of your initial stop. Now, the adjustment of stops are different from trailing stops. Trailing is adjusting, but adjusting is a one adjustment and then that's static. Trailing is a different mode. It's a continuously moving trailing item. An adjustment stays static for a while until the next adjustment. The trailing is never immobile. It's constantly in motion. So there's the adjustment of stops, the trailing of your stop, and the profit taking. All three of those components make up trade management. And you can throw in the add. We kind of separated it with the RBI, but you can throw in the add there as well. And when we come back, we touch upon those items. So it is now 1:15. Let's take a 10-minute break. We will come back at 1:30.